I mean, certainly as rates are going up, that we should be getting more demand for bonds. But when the velocity of move is so intense to the upside, nobody really wants to jump in there. They can really spike up to levels that cause a credit crunch and a recession. I'm hoping that the economy will slow some without an outright recession, and that inflation will continue to moderate, and that will stabilize the situation. But we are seeing aspects of a debt crisis which are very unsettling.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting, as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunn.
Thanks very much for the introduction, Niels. Today, I'm delighted to be joined by Ed Yardini. Ed is the President and Chief Investment Strategist of our Yardeni Research. Ed has been on Wall Street for over 25 years as a chief economist and a chief investment strategist in multiple houses. He's also worked at the Federal Reserve and US Treasury. He's also a frequent commentator on the financial media, such as CNBC. Ed, great to have you with us today. How are you doing?
Just fine, Alan.
Good stuff. Well, before we get into the meat of the conversation, we always like to get our guests to give a sense of their background in markets. Obviously, you've been around analysing the markets and the economy for many years. So if you could just give us a sense on how you got started in economics and as an economist, and then transitioning into investment strategy.
No, I'm sorry you want to do that because it's going to sound like I can't keep a job. I went to Cornell for undergraduate, studied economics and government. And then I went to Yale and did first a master's in international relations and then a PhD in economics. I studied under James Tobin. He's a Nobel Prize winner. And I was there. I graduated 6 years after Janet Yellen graduated from Yale. And I owe her a debt of thanks because she wrote these very copious notes from Tobin's class. And they were subsequently Xeroxed and sort of became the unofficial textbook of Tobin's class. So she got me through Yale. Of course, she's a liberal, where I tend to be more conservative, at least on economic policy matters. Graduated from Yale, went on to for a stint at the Federal Reserve Bank of New York for a year. Had a office with no windows. I think I had a polyester white shirt that I wore on a regular basis and kept some ties in the office. Wrote some memos on the savings and loan industry, which was in crisis back then. And, well, actually it was pre-crisis, but just kind of monitored their deposit flows. And those memos, I think, are still somewhere in the basement of the Federal Reserve Bank of New York in some file, I suspect. Then I got a call from a headhunter on Wall Street who said there's a job opening at E.F. Hutton. You know, when E.F. Hutton talks, people listen was their motto. And so I went to E.F. Hutton and as a kind of a junior economist working for the senior economist. And the senior economist was very kind. He moved on after a couple of years and So at the age of 28, I became the chief economist of E.F. Hutton. From there, I moved to Prudential, which was called Prudential Bache at the time. It was called Bache at the time, and then it became Prudential Bache. And then from there, I got a job at C.J. Lawrence, where Ed Hyman was the chief economist, renowned economist. And so I took over that spot and stayed there for some time. It kind of morphed into Deutsche Bank Securities as Deutsche Bank bought C.J. Lawrence. And then after that, I went back to Prudential for a couple of years. Then that kind of ended my career directly on Wall Street. For a couple of years, I worked for Oak Associates in Akron, Ohio, managing money. And I continued to write do my research, and we sold it to our institutional accounts that I had contact with when I was on Wall Street. And then I decided just to go off on my own in 2007. We were virtual from the get-go. So I tell everybody since the pandemic, welcome to our world. We've all been working from home since 2007. And here I am, president of Yardeni Research. And we have over 4,000 individuals at major institutions around the world that get our research. And we have a product for individual investors, if I may give a quick commercial. It's Yardeni Research, Yardeni Quick Takes at yardeni.com for individuals. And I wish I could give you some cough drops. I hope you're...
Hopefully that won't persist.
No, good.
Well, great. That's a great history of some of the big names on Wall Street, I guess. And I guess, as you mentioned, you've worked as an economist, both on the policy side and on the buy side. I guess one of the things that's been interesting about the current cycle is how wrong, again, the economics profession seems to have been about the economy this year. Starting the year, there was a lot of pessimism around, and Jamie Dimon talking about that, whatever, the hurricane or the gale that was approaching, that hasn't...
That was May of last year, sure.
Yeah. So we obviously had a bit of a wobble with the banking issue in March, but what's your take? I mean, why has the economics profession got it wrong again? And what's interesting about this cycle that the economy is so resilient?
Yeah, well, fortunately, I think I got it mostly right, not completely right, but I actually started arguing early last year in early 2022 that the economy was in a recession, but I explained that I thought it was a rolling recession, otherwise known as a mid-cycle slowdown, a growth recession. The idea was that the Fed was raising interest rates, which is what got most economists to start forecasting a recession. They figured that if the Fed was going to be aggressive in raising interest rates, and if inflation was going to be persistent rather than transitory, then the result would be a credit crunch and a recession. I didn't see it that way. I said that for starters, we have a housing recession, but we have to be exact about that. It was a single-family housing recession. Housing starts for single families took a dive. Multifamilies remained very strong because developers and landlords realized that there was a lot of demand for rental properties, for apartments. And so that's been very strong just until recently. In August, we saw a big drop in that, and that may be the rolling recession now rolling into multifamily housing because they might have overbuilt in that regard. Then here in the U.S., we were locked down during the pandemic in March and April, and we all got cabin fever. I guess we avoided COVID, but we got cabin fever for sure. And when the lockdowns were lifted, we all needed to do something to make ourselves feel better. And the wonderful things about Americans, maybe lots of other people, is when we're happy, we spend money, and when we're depressed, we spend even more money. And so we ran out and started going on a shopping spree, a buying spree. Couldn't get really much in the way of services because there were still social distancing requirements. And so we bought a lot of goods, and basically inventories were depleted by late 2020. Retailers ordered a bunch more merchandise from China and other places that all got jammed in the ports of L.A. and there weren't enough trucks to bring it all. By the time it all arrived, the consumers basically said, no mas, we don't really need any more goods. We have enough. And they went on a buying binge for services. They went traveling. They went to restaurants. They stayed at hotels, motels. More recently, they went to Taylor Swift concerts or went to see Barbie and Oppenheimer at the movies. So the retailers got stuck with a lot of merchandise and had to discount it, which brought inflation down quite sharply, at least in the goods area. Now the rolling recession is rolling into commercial real estate. And look, I'm not saying that we couldn't still have an economy-wide recession, but there's been a lot of economic correcting in some important cyclical sectors.
Very good. And I mean, one of the things people have been, I suppose, focused on trying to grapple with is this kind of what are the lags for monetary policy and different views on this. And, for a while, Powell was suggesting maybe some research that the lags might have sped up, but, as the expression is, they are long and variable, so hard to forecast. What's your sense on when we should feel the maximum impact of the tightening we've experienced already?
As I just indicated, I think we've already seen that the impact was quite immediate in the housing market. And I'm seeing some signs that the single-family housing market may be bottoming. I don't think it's going to recover much with mortgage rates going from 7 to 8%. So we've had that happen pretty quickly. We're actually seeing a rolling recovery in goods. The latest manufacturing survey, the Manufacturing Purchasing Manager Survey, suggests that we're starting to see some pickup in manufacturing. The so-called MPMI, the Manufacturing Purchasing Managers Index, is still below 50, but it's actually been rising towards that level. I think it got to 49 in September. So it's been improving. But the long and variable lag is certainly going to be hitting commercial real estate for a long time, and it won't be that variable. I think it's already started. And look, a lot of commercial real estate was financed at near zero interest rates, and some of that is variable, and some of that has to be refinanced. And the math just isn't going to work with interest rates now substantially higher. And so we will see a lot of defaults. We'll see some significant losses for the banks, kind of reminiscent of what happened in around 1990 when we had the savings and loan crisis. Again, I pointed out that I had a head start on looking at the savings and loan industry when I was at the Fed. So I was sort of on top of that situation. But it took a long time. But we had a minor recession back then. Didn't last very long, and then it kind of weighed on the economy for a while. So that may be what we have up ahead here. The consumer clearly is the key question, and is the key reason that we haven't had an economy-wide recession. And there are folks out there who still think that consumers piled up this excess savings, so-called, during the pandemic, and that they're running out of that. And as soon as they run out of that, they'll have to retrench. They'll have to cut back. Consumers face some other headwinds, such as student loan payments have started once again. And so that could potentially weigh on the consumer. But meanwhile, the labor market remains really strong. It's hard to get a recession when workers are getting jobs. And we just had a job openings data for August that showed that there's plenty of jobs that are still available. And so that employment still looks pretty good. And by the way, wages for the past several months have been rising faster than prices. Didn't happen in August because of energy prices, but the trend has been for an improving real wage environment.
Very good. And I guess another interesting part of the puzzle that we've been grappling at the moment has been the behavior of long-term bond yields. And obviously for a long time, yield didn't really respond that much, somewhat, but maybe not as much as expected in response to the Fed tightening. But more recently, we have started seeing bond yields started to ratchet higher. So how do you see that, or what's driving that, and how do you see that out?
Well, funny that you should ask. We're doing this podcast on October 4th, and just happened to have a op-ed on that in today's Financial Times, and it's called "The Bond Vigilantes Are Back." I coined the phrase "bond vigilantes" back in 1983, and the idea is that if bond investors conclude that fiscal and monetary policy is reckless, it's too stimulative, it's too inflationary, that's obviously not in their best interest. Then they basically send their friends, the bond vigilantes, to take over the credit markets. Now, for a while there, they really couldn't do very much between the great financial crisis and the great virus crisis. Central bankers were buying bonds, and they were lowering interest rates close to zero, at least to historical lows in the bond market. And as a result of that, they were trying to. The central banks were desperately trying to get inflation to go back up to 2%. But beware of what you wish for. Here, inflation is much higher than that. And so the central bankers have had to reverse course and raise interest rates. As they've raised short-term rates, bond yields have kind of followed along. But then sometime last summer of 2022 exactly, not 2023, but a while ago, the yield curve inverted, meaning that bond yields still went up, but not as rapidly as short-term interest rates, because bond investors figured, the Fed's doing it right. They're aggressive. They're focused, laser focused on bringing inflation down. So, if the Fed keeps going, something will break, as it has in the past in the financial markets. There'll be a credit crunch. There'll be a recession. So it's okay to buy a bond at 4% when the 10-year bond at 4%, when the 2-year note is at 5%. Because odds are the 2-year note's not going to stay there very long once a recession hits. And the inverted yield curve, of course, caused a lot of forecasters to anticipate a recession. Well, and in fact, the yield curve got it partly right. We had a banking crisis in March of this year. Didn't last very long. The Fed came in and squelched it contained it with a banking liquidity facility. And we didn't have a credit crunch. We didn't have a recession. But recently, this summer, we've seen that the bond investors have become increasingly concerned not about reckless monetary policy, but they've become concerned about reckless fiscal policy. As we know, Fitch Ratings downgraded U.S. government debt back on August 1st. And they really didn't tell us anything new. It just reminded everybody that with all the spending programs that had been enacted by the Biden administration in 2022, that the outlook for outlays was daunting. And meanwhile, there was no political will to increase taxes. And so the deficit suddenly in August on a 12-month basis was $2 trillion. And the auctions for the Treasuries securities increased substantially. And the bond vigilantes came to the fore and said, okay, well, we're not going to buy bonds at 4%, especially if there's not going to be a recession. And we're going to need a lot more in order to buy all the supply. So as of our podcast, we're at 4.8%. It's been a vertical ascent in the bond market. And basically the bond vigilantes are saying, if you folks in Washington don't do something to narrow this deficit, we're going to push bond yields up to whatever level it takes to get your attention, and of course that would be by creating a debt crisis, or at least a debt crunch, and a recession. So that's where we are right now.
And it was interesting. I think Barry Eichengreen had a paper that he presented at Jackson Hole about debt and debt sustainability. So and he's been a guest on this podcast too. So we follow his work with interest. I guess it was interesting in itself that people at Jackson Hole were focused on debt dynamics in the first place. And I guess the conclusions from his paper were, well, okay, maybe not kind of forecasting an imminent crisis, but certainly the trajectory of travel didn't look good, in the sense of, if you look at, the conditions normally in place for kind of reduction of debt levels and fiscal primary surpluses, that they're not in place now. So the question is how you would get debt down. And his argument seems to be that we should just get used to living with high levels of debt. But he did focus a lot on this equation that I guess economists look at, or the relationship between R and G, to kind of infer whether debt is sustainable or not. I mean, how far away do you think we are from kind of a negative spiral of higher rates pushing up, more debt repayments and then piling on more debt and all of that, and reaching a crisis at some point in the future?
Well, we're actually there. We've been there for probably the past year, maybe past 2 years. We've accumulated a tremendous amount of debt before the pandemic, a lot more debt during the pandemic, and now the deficits remain wide and are widening, which is unsettling to see in an economy that's still growing. Because the bond market really never had a problem with widening deficits in the past, because they widened during recessions when private credit demands were shrinking, and when interest rates were coming down as the Fed was fighting a recession. This time around, the economy's hanging in there quite well, and the deficit's widening because of fiscal excesses, and so that's quite a change. And where we're having the problem, this is not all because of Biden's spending programs, which really haven't even kicked in yet. A lot of this has been Social Security payments are ratcheted to inflation, so they've been ratcheted up. And then the big problem is interest expense. All that debt is generating increasing interest outlays by the U.S. government, and that's something that's non-discretionary, as they say. The government has to make those payments, and we've seen on a 12-month basis those payments double since July of 2022 to about $650 billion or so, and they're going straight up. So a good part of the deficit here and now is in fact attributable to a rapidly rising interest costs. And that's, I think, got the bond vigilantes particularly riled up, because they realize that there's sort of a spiraling debt problem with regards to the government, with no political will to even recognize that problem or do anything about it. So there is this right now. I'm an optimist at heart, believe it or not. So I tend to believe that it doesn't necessarily have to end badly. You mentioned one economist. There's the hedge fund community is also convinced that we're going to have a debt crisis. Ray Dalio has talked about a debt crisis, and the idea is really quite simple. Bond yields are going to go up to whatever level it takes to make bonds attractive again. Certainly as rates are going up, that we should be getting more demand for bonds. But when the velocity of move is so intense to the upside, nobody really wants to jump in there. They can really spike up to levels that cause a credit crunch and a recession. I'm hoping that the economy will slow some without an outright recession, and that inflation will continue to moderate, and that will stabilize the situation. But we are seeing aspects of a debt crisis which are very unsettling.
And do you think, it's a side question, but curious to get your perspective, did the US Treasury miss a trick not issuing 100-year bonds like the likes of Austria and Argentina did back when rates were zero? And now their profile presumably of the debt is kind of more near term. Is that fair to say?
Yeah, I was always kind of wondering why the Treasury didn't take the opportunity of such low interest rates. The 10-year Treasury yield got down to 0.5% in 2020, I think it was. Why not just refinance everything at 10 years or 20 years or, as you said, 100 years? And I don't know the answer to that. I think Wall Street told the Treasury that they need to have a range of maturities in order to keep their government bond desks going. But here we are with interest rates a lot higher, with a lot more debt. We've calculated that currently the Treasury is paying on average 2.5% on its debt as it's had to refinance it. 2.5% is not where the 2-year note is right now. It's at 5%. So as they have to continue to refinance their debt and accumulate more debt, they are going to have more and more outlays for net interest.
Okay. And I mean, you touched on, no political appetite to address this. And it's interesting to think about, some of the political headwinds. On the one hand, you touched on Bidenomics and this kind of shift towards greater industrial policy, fiscal activism in the US, which would suggest we would see ongoing deficits over time. And then obviously we're in the middle of the usual logjam in Congress at the moment. So very hard to see how this would play out positively. But I mean, what is the end game? I mean, maybe, as you say, our economy goes into recession and that brings yields down. But if this debt issue was to roll on for a number of years, is it the case that we have to see much higher levels to precipitate some kind of sense of crisis, do you think, to get policymakers to act on deficits?
Yeah, I think that's right. I mean, we've seen in the past that the policymakers don't really respond to changing policy on the economic side unless there's a crisis. We certainly saw that with the great financial crisis. But the bond vigilantes' heyday was actually back during the Clinton administration when James Carville, who was an advisor to Bill Clinton, made him very aware of the power of the bond market. And in many ways, the bond market's more powerful now because it's bigger. There's just been a lot more debt, and there's a lot more leverage in the economy. So it's a clear and present danger that, frankly, I didn't see it coming. Because it's always been my view that I'll worry about debt when the bond market worries about too much debt. In the past, the bond market really didn't focus much on supply and demand in the bond market, particularly not in the treasury market, because, as I said, the deficits widened in recessions, and that was not a big deal. And then they narrowed during expansions. But the bond market now, I think really since August 1st, since Fitch ratings lowered the downgraded government debt, the bond market now seems to be very much concerned about the imbalance between the supply of securities and the demand. And the demand's been diminished because the Fed, instead of buying treasuries, is letting its portfolio decline. It's letting them the bonds mature, the portfolio mature, and then of course the commercial banks have seen some weakness in their deposits, and so they're letting their bond portfolios mature to raise funds to offset some of that weakness. So that leaves domestic individual and institutional investors to buy treasuries and foreign investors, and there's a lot of questions about whether foreign investors have the appetite to buy our securities. So it all adds up to a situation where the elements of a debt crisis have suddenly appeared kind of out of the blue, but they were actually, hiding in plain sight all along.
Yeah, interesting. There was an article from James Montier at GMO there, I remember reading a few months back, called Slow Burning Minsky Moments, and it was kind of on that theme that the debt level preconditions for a Minsky moment were in place, if not the kind of immediate dynamics, but obviously the immediate dynamics are shifting. I guess the going back to the Eichengreen paper, in terms of debt sustainability, there's two sides of it. One is the interest rate and the other side is economic growth. I guess the optimists might say, AI might save us and we could have a productivity boom and economic growth could end up being very strong. There's different views on this. What are your thoughts on that?
Yeah, well, again, our conversation has clearly been on the pessimistic side with regards to the debt issue. But believe it or not, I'm in that camp that believes that growth will save us and that productivity will save us. I don't know if it's AI. I think it's a combination of technologies that will boost productivity. I've been arguing that productivity, that we are in the early stages of a productivity growth boom. We had a productivity growth boom in the 50s and the 60s, another one in the 90s. This one has the potential for being much broader in scope because the technologies that are out there do lend themselves to solving a very significant problem we have in the economy here and around the world. There's a shortage of labor, there's a shortage of skilled labor. And so companies really desperately need to increase the productivity of the workers they have. They need to augment their skills with the technology. And I think it's artificial intelligence, it's robotics, automation, nanotechnology, 3D manufacturing. There's just a host of technologies that are very user-friendly. They're relatively inexpensive, and they do lend themselves to increasing productivity in just about every business. So from that perspective, almost every business now is a technology company. If they don't make technology, they have to use technology. They have to spend a good part of their capital budgets on technology to increase their productivity. That being the case, we may very well have a productivity boom. Productivity on a 5-year trailing basis at an annual rate bottomed at 0.4% back in 2015. It got all the way up to 1.6% right before the pandemic. That doesn't sound like a lot, but that's a quadruple increase in productivity, and it's all goes straight into real GDP growth. In other words, if productivity was adding 0.4%, suddenly it was adding 1.6%. And then the pandemic hit and everything got screwed up. People quit, and hard to maintain productivity when people are quitting and you have to hire new people. But I think things are normalizing now, and I expect productivity, which is back to 1.6% on that trailing basis that I just mentioned. I think it's going up to 3 to 4%, which sounds far-fetched, but that's the kind of productivity booms we've had in the past. And if we get that, that'll help a lot in boosting growth. Because again, if productivity is growing 3%, labor force is growing 1%, that's 4% real GDP.
And I mean, it's always the great. I mean, everything in economics is difficult to forecast, I guess, but productivity in particular, and it's often kind of treated as a kind of a residual. I mean, you've got the growth numbers and the population growth. I mean, it's so hard to know. Say McKinsey had a report out on AI saying it was going to boost productivity. I think anywhere between 0.2 and 0.6, might have been even higher, but it was a pretty wide range. But they were saying that the benefit mightn't come for another 10 years. And even after the internet in 2000, it was probably, I don't know, maybe 10 years before we saw the productivity numbers really pick up. So is it, when you think about that, are you just observing what you're seeing in the real economy amongst different companies, or how do you get confidence in that forecast?
Yeah, I mean, you're right, but there are data series that we can kind of monitor that. I mean, there is quarterly data on productivity. It actually bounced very nicely to the upside in the second quarter, but it can be volatile from even quarter to quarter. But I'm monitoring that, and as I said, I monitor the kind of 20-quarter average growth rate at an annual rate to kind of focus on the cycles, and that looks like it's stopped going down, suggesting that. And I'm watching the quits. I mean, obviously, if quits are coming down, that should help to stabilize the labor market. You're not having to retrain new hires. I'm watching real wages. There's a very strong correlation, not surprisingly. This is the one thing I studied in economics, particularly microeconomics, that actually I can see on a chart that makes sense. And that shows the productivity growth rate versus the growth rate in inflation-adjusted real compensation. People get paid their productivity in a competitive marketplace. So if you have a relatively competitive marketplace, wages will go up faster than prices as long as that's sustainable and supported by productivity. And so I'm watching on a monthly basis average hourly earnings, which is wages, just the wages is not total compensation, but that's what I have on a monthly basis divided by the consumption deflator, which is kind of like the CPI. That's been recovering this year after stalling last year. And then I'm watching quarterly, and then I have weekly data indicators of corporate profit margins. and corporate profit margins were very weak last year, and they seem to be recovering this year. So you're right. Productivity is sort of a squishy topic, and to say, oh, AI is going to increase productivity doesn't really help you much. Personally, I've tried to use it for what I do, and it's been useless. It's just got all these errors. So I've just gone back to just Google links and finding the original source and writing it myself rather than having Bard or Bing write it and then having to fact check the AI.
See, you don't have ChatGPT writing the daily commentary quite yet.
No, not yet. Not yet.
You touched on the 1990s experience a moment ago when we were talking about the rate hikes and the commercial real estate challenges. You've seen cycles gone back, I don't know, I guess 30, 40 years. People always want to draw parallels, and you're talking about this productivity boom, which is, I guess, reminiscent of the late 90s. But equally, there's the parallel between the early 90s. I saw you had a piece a couple of days ago looking at comparing versus the 70s, but highlighting maybe more differences versus similarities. I mean, how do you draw on that experience? There's always parallels, but always differences. When you look at everything together now from a capital markets, from an economic perspective, each cycle is different. What stands out in terms of parallels? Obviously, you touched on 1990. Anything else?
Yeah. Well, I wrote a book back in 2018, turned out to be longer than it should have been. I think it was like 500 pages or so, called Predicting the Markets, a professional autobiography. And it basically was everything, almost everything that I learned, learning by doing over the past 40 years of my professional career. So in some ways, it's a history lesson based on, how I was sort of like Forrest Gump. I was there at the time that some very interesting economic history occurred. Very fortunate, because I think the past 40, 45 years have been absolutely fascinating and radically different from anything we've seen in the past. So I think history is very important in assessing where we are now. Some things, history maybe doesn't repeat itself, but it does rhyme, as they say. And there are a lot of useful analogies. But it's also important to recognize, as you said, what's different this time. Sometimes that's viewed as a jinx when an economist says, well, it's different this time. Then for sure it's just going to be the same old. And usually they're saying why it's not going to be bad, and it turns out to be bad. I may be in that position because I've been arguing that it's a rolling recession. We're not going to have an economy-wide recession. I've been arguing that inflation is turning out to be transitory after all, not persistent, and that productivity is making a comeback. And so, maybe I'm just going to be wrong about all of that. But I've acknowledged, I'm trying to be not just optimistic, but realistic. I've acknowledged that there are some significant risks, and a debt crisis of the nature that people like Ray Dalio and some of the other hedge fund people have been talking about is a realistic scenario. It's a plausible scenario, but it doesn't have to end as badly as they think. And things change. I mean, demography changes. So I've also become an amateur demographer over the years. I'm 73 years old, so I'm a card-carrying member of the baby boom generation here in the U.S. And many years ago, I had this egotistical view that I was very special. And then I realized there's 75 million people that are just like me, other baby boomers, who are more or less doing the same thing. We went out of college. We had this mindset that the next thing we did was get a job. Hopefully, we'd work for that company forever, collect a pension. We moved to the suburb after we got married, have children, and that was the mindset. Obviously, that's not the mindset of the younger generation now. But one of the insights based on looking at my life as something that's not unique, that I see is what's different about me is I'm still working for a living, whereas a lot of my friends are actually retiring. And that's a radical change in one's lifestyle. It's like you suddenly think to yourself, well, wait a second, I'm not getting a paycheck anymore. So, that's why I saved all that money, and now it's time to start spending it. But what if I live a long time, and what if I'm not healthy, and how much do I want to leave the kids? So there's a lot of questions that the baby boomers are facing now, but one of the things that's clear is that they have a lot of excess saving. All this talk about excess saving during the pandemic, how about all the retirement assets that have been saved by baby boomers? And there's something called 401ks in the U.S. where people are actually, once they turn into their 70s, are required to take money out of there. Now they could save it, I guess, in another instrument, but they may very well say, now that I got this check, I'm going to spend it. So the baby boomers, the retiring ones, my friends are going out to restaurants. They don't cook at home anymore. They're traveling quite a bit. They're using the healthcare system quite a bit. This, by the way, explains why the economy has been so resiliently strong. Is we've got a lot of demand for workers in the healthcare industry, all-time record high. A lot of demand for workers in the hospitality industry, all-time record high, and so on.
Yeah, I think that's very interesting because I mean. People often talk about demographics and, just say, aging of the population is deflationary when as you say, there's so many dynamics and dimensions to this in the sense of, it depends on when people, how they forecast how long they expect to live. And, as you say, people will spend more, but then equally there is the dimension of there will be more demand for people to support older people, so healthcare workers, and that's the Charles Goodhart argument, and obviously what we're seeing as well from people are tending not to have kind of heart attacks and kind of those types of diseases, but more mental Alzheimer challenges, etc., and that increases demand for care workers as well. So it's hard to say. Is the baby booming population, is that more of an inflationary or deflationary force? Hard to say, or what would you say?
It's hard to say. I mean, I don't think. I mean, right now it's more of a reason why the economy has been resilient. I don't see that it's been a source of inflation. I think, with the benefit of hindsight, we will discover that inflation was a fairly transitory phenomenon related to the pandemic. There was too much fiscal and monetary stimulus, but all of that fueled a goods buying boom that we discussed earlier in our discussion. And they got stuck in the ports and so on and so forth. I think where the demographic factors are much more deflationary is in China, which, we haven't really talked about the global dimension, but I've described China as the world's largest nursing home. I don't know if I'll ever be able to go there because, they might stop me for questioning why I said things like that about them. But it's the world's largest nursing home. The demography has turned very geriatric, exacerbated by the one-child policy. And now we're seeing that China's slowing down and their property bubble is bursting, or at least it's leaking lots of air. And so China's slowed down, which on the one hand is bad for global economic growth. On the other hand, it's fundamentally deflationary, which helps to bring our inflation down, particularly in the goods market.
Yeah, no, you're right. It has been a big theme is this potential Japanification of China. Would you go that far in terms of the outlook over the next couple of decades? Do you see that kind of deflationary impulse becoming embedded? Well, I mean,
the Chinese government, the Chinese Communist Party, to be exact, is really the source of China's problems. I mean, China's prosperity really occurred when the Chinese Communist Party kind of stood back and let capitalism work. But they've been squelching that of late, and the Chinese Communist Party imposed the one-child policy that now is coming back to haunt them. Now they've tried to provide incentives for people to have children, and it's just it's not working. And so I think that the demographic prospects for China are pretty grim. In some ways, China's just a big version of Japan. Japan's also got a very geriatric demographic profile. Things aren't terrible in Japan. They've got a pretty good standard of living, but they don't have a young population that will stimulate growth in the future. And so China has that same problem.
And outside of China, like obviously there tends to be as much optimism now maybe about the outlook in India versus pessimism in China, and in some of the other emerging markets benefiting from maybe deglobalization, people looking at Mexico, Vietnam, areas like that. Do you think that's an opportunity for investors?
Well, interestingly, thanks to Zoom technology and all that, over the past several months, I've actually been doing a regular discussion with CNBC India, and so as a result, to make sure that I'm, if they ask me a question, I have some knowledge of what's going on in India. I've been following that more, and India's got a young population. They speak English, which is good for doing business with the United States, Australia, and other Canadian, other English-speaking areas of the world. They are working on infrastructure. That's where China has them beat. China has great infrastructure. China has things organized remarkably sensibly when it comes to the way industries can get parts and so on. So India's got a long ways to do all that, but India is increasingly being viewed as an alternative to China. But so is the United States. I mean, we've seen in the United States, there's data on construction of manufacturing facilities, and it's gone straight up. We're building more manufacturing here because of onshoring, as the word goes, and onshoring's been the reaction to the increasing tensions between the United States and China. It's been a reaction to the pandemic, and it's also shows that technology is now available to replace labor. Labor is not so cheap even in China anymore. It's not available. Maybe it's still relatively cheap in India, but all in all, technology is allowing American manufacturing to come back, even if we don't have the workforce that is necessary to run factories, because now we've got robotics and automation. I'm fascinated to see that Elon Musk is working on all these technologies, and one of his ventures is robotics. And these robots, I've seen a video of it, look like they're being trained to build cars.
Okay. Well, that's interesting. I mean, you touched on a little bit earlier corporate profit margins, how they were came down a little bit last year, seem to be improving this year. So, I mean, in that context, I mean, just bringing the discussion maybe towards the outlook for equities, you're talking about the onshoring, which you would have thought maybe might push up prices and costs for companies. Presumably if they went offshore for cheaper costs by bringing it onshore, it's more resilient chains, but maybe at a higher cost. So how do you see the valuation perspective and the outlook for equities?
We started off with a relatively pessimistic discussion of a potential debt crisis. So with the proviso that I'm keeping an eye on the 10-year bond yield to see what my friends, the bond vigilantes, are going to do, I think there is an optimistic scenario here. I think it's actually my base case for now. I'm assigning a 75% probability to a continuation of rolling recession with inflation coming down and things stabilizing here. So the bond yield doesn't kind of shoot up above 5% is a requirement of this relatively happy scenario. Earnings have turned out to be better this year than others expected. We actually got it right because we didn't have an economy-wide recession. And we think that earnings are going to continue to improve next year. So the earnings outlook, I think, suggests that we're still in a bull market, that the bull market started on October 12th of last year. At the end of October last year, if I toot my own horn, I said that I thought that was the low and that we were in a bull market. And it looked pretty good until July 31st. And then we've had, I think, a correction since then. I don't think it's a beginning of a new bear market. I don't think it's a resumption of the old bear market. But there's that 25% that I'm subjectively assigning to the possibility of a hard landing recession. And I've recently actually raised that from 15 to 25%. So I'm sensitive to the risks. With regards to valuation, I think we just have to be, we just have to factor in that I call them the mega cap 8. Some people call them the magnificent 7. The big tech companies that account for 25% of the market capitalization of the S&P 500, they're not going away. These are very profitable companies. They're doing extremely well. And so they're going to continue to account for 25, maybe 30% of the S&P 500. And they have high valuation multiples. They try to bring those multiples down, then they rebounded somewhat. So I think you have to factor that in. But when you look at the market, then you really have to look at the mega cap 8 versus the rest of the market in terms of valuation. And the valuation of the market, excluding the mega cap 8 right now, is around 15, which isn't dirt cheap. It's about kind of fair value, but it does suggest that there are opportunities in the marketplace. We continue to like energy. I know financials hasn't been doing well this year, but financials, the big cap financials look quite good. In some ways, they're technology companies because they're spending billions of dollars on technology. Technology itself, IT, is a place where we want to continue to have exposure. So, we're aware of the doomsday scenarios. We're aware of the debt crisis scenarios. If you wanted to spend a whole hour saying, okay, let's depress everybody and just talk about how everything could go wrong, I know that story pretty well. I always point out that the pessimists don't seem to know my story very well, which is the more optimistic one.
And I mean, you talk about kind of the mega caps versus the rest. And then if you were to look at outside the US versus the US, outside the US, the valuations look more attractive. But then the question is, will the earnings growth be as strong? What's your perspective on that?
Well, I've been in the stay home camp from the vantage point of American investors. And what that means for global investors is you want to overweight the US. I've been saying that for quite some time here. Maybe I'll overstay my welcome, but I'm still in this stay home, overweight the U.S. It doesn't mean don't invest overseas. It just means overweight the U.S. Europe has some real challenges. China has some real challenges. Maybe there's some opportunities in Japan, maybe some opportunities in India and Brazil. But in terms of liquidity, in terms of diversification, rule of law, transparency, the U.S. has a lot going for it. And it's still, the world's largest economy with the world's most dynamic technologies, with a consumer that was born to shop. So I would continue to overweight the U.S.
Very good. Well, I think we're just coming up in time. So we always kind of just wrap up by getting some perspective, advice maybe for people coming into the markets, younger people starting off, as to things to do or read. Obviously, you've been through everything in the markets. What would your advice be to people?
Well, if I had, if I was starting all over again, I would have saved more, even if that meant kind of reducing my standard of living. And I would have put it in high quality dividend yielding stocks, companies that have been around for a long time, that have been growing their dividends, paying more year after year, and put them away, and not get involved in the day-to-day battles that we have in the financial markets. You can really get whipsawed around quite a bit in the stock market and even in the bond market. I think you have to buy quality, buy securities that are giving you a good return, and then just put them away and try to get some peace of mind, because if you're trying to trade these markets, it can be quite tough, very difficult on you for an individual investor.
Very good advice, I'm sure. Well, Ed, thanks very much. This has been a tremendous conversation. Thanks very much for doing this today. So make sure to follow Ed's work, because as you can tell from today's conversation, We're living in a fast-moving global macro world, and it's more important than ever to stay well informed. So from all of us here on Top Traders Unplugged, thank you, and we'll be back soon with more episodes.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.